Winnie, it's real simple. On a blended corporate index, I'm down 16%. I'm down 21% annualized. Is that a bond bear market?
It certainly feels like a bond bear market to a lot of investors, but we're also seeing a pretty attractive reset in yields, which is actually getting a lot of attention back into the market, where we have investment grade yields that are now above where they were for the peak COVID volatility in March of 2020. So that income generation property is feeling a lot better right now, despite those really terrible total returns so far this year.
Which is the reason why, Winnie, why I'm not surprised that you're seeing so many more inquiries from investors. What are their main questions in terms of the parameters of risk and the stress case for some of these names?
So the number one question is, does the U.S. or the broader global economy go into a recession? And if so, what does that recession look like? Is it severe? Is it drawn out? Is it more shallow? Is it more of a reset based on growth expectations that are not quite as optimistic as perhaps where we had been during very easy monetary policy and that COVID-driven growth? So everybody's trying to handicap what does the actual outlook for things like downgrades and defaults, because that's where you're actually going to start to see some capital lost in the investment grade and high yield market actually look like, or are we going to be able to kind of muddle through because fundamentals heading into this slowdown are actually in very good shape overall?
So given your fundamental analysis, Winnie, what have we priced in already, given yields at 8.5% for junk and for investment grade well north of 5%?
So what we're pricing in right now is a much more normalized outlook for things like downgrades and defaults. At almost 5% for investment grade, that's very much an attractive kind of income generation and also compensates you for some credit risk in terms of downgrades. We also have a much longer duration in the investment grade market, which is playing a little bit of complication into valuations, because much lower coupons means that bond prices have to fall a bit more to get you to that higher yield. In the high yield market, we have a distress ratio, so issuers that are kind of stressed, perhaps facing some economic challenges in the future, that has risen, but not necessarily risen to a level that coincides with a massive uptick in defaults overall. And so we're really pricing in kind of a more normalized default environment, call it the 2 to 3% area over the next 12 to 24 months.
So Winnie, is essentially what you're saying that we're not going to see enough stress within credit markets that the Fed presses pause or at least takes its foot off the accelerator?
I think that that's probably a fair assessment, at least for now. The Fed is very focused on whether or not capital is flowing into the credit markets when issuers need to raise that capital. And so far what we've seen is issuers are able to come to market and price deals. Now these are at much higher coupons or borrowing costs than last year, but deals are still getting priced fairly efficiently. And instead what we're seeing is that most issuers have done a really good job of pushing out maturities, of locking in really low coupon debt last year in the second half of 2020, which means that there's a little bit less to do on the issuer side of things. And that gives the Fed a little bit more air cover to continue to tighten policy.
So what are your expectations for issuance, considering how we saw so much of it over the low rate pandemic area? But as you say, borrowing costs are now higher. How many more companies are going to want to come to the debt markets?
So for the next 6 months, we are expecting that issuance is going to slow down compared to the first half of the year, especially in investment grade. That's a very typical seasonal pattern. We tend to get a little bit slower back half than front half. And this year, what we saw was a lot of financials-driven issuance in the first half of the year. And most years, most of those financials-aligned issuers actually price the big bulk of their new issue in the first half of the year. In the high-yield market, I think that the borrowing and new issue is going to be a little bit more dependent on what happens with spreads and yields. For right now, the bulk of higher-rated, so double B high-yield issuers, they have very little to do, and it's more on a kind of need to borrow basis that we're going to see the single Bs and triple Cs come to market.